morning, everybody. We're recording November the 8th. We have Jonathan Golub on, the head of U.S. strategy and quant research at Credit Suisse. And we have Tim Pierotti as well, our chief investment strategist. It's been a while since Jonathan's been on. We're going to have a good conversation about earnings and elections and a lot of different topics. So let's get started. Let's start with you, Jonathan. So the earnings season's been stronger than expected. And it's kind of resulted, marginally, I'd say, and it's resulted in some back-to-back weekly gains. Inflationary concerns resulted in a flight from capital markets, but at the same time, we've seen the economy grow modestly in the third quarter. And when do we finally see a drag on corporate earnings and overall economic downturn?
Gosh, so there's a lot to unpack there. I think that's like 10 questions all built into one. So it's really interesting. We looked at we looked at the way that markets and earnings and stuff work over the last 50 years, and we actually found that corporate profits around recessions really kind of group into two buckets: the periods where high inflation and the periods with low inflation. In the periods with high inflation, it actually is pretty good for corporate profits, because they're measured in nominal terms. Like if a company is charging more for their product, they may not be selling more of it, but in dollar terms, their profits go up. And so with inflation this high, it's actually likely to be pretty good. And we're probably going to see profit growth for the next, several quarters or longer. What you are seeing is this kind of interesting mix, Drew, where revenues are on fire. Like when I say on fire, 10.5%, 11% revenue growth, and you have something, EPS growth is running more like 6%, which is, not a disaster, but there's a fair bit of margin contraction. We actually think that that's going to continue a bit, as over the next few quarters, where revenue stays strong, but the margin pressure continues. And the reason for that is wages continue to be sticky, but CPI pricing power is coming off a little bit. As things like cars become available in the marketplace, these big premiums that people had to pay to buy a car, those are going to go away. There's a variety of areas. We no longer have the backlogs, so there's a little bit of a loss in pricing power, but there's not really much of a decline in wages. So that's going to bite into the numbers a little bit, but they should still stay positive.
So you have been ticking down your numbers a little bit here as companies have guided down for Q4, and we still haven't gotten a ton of guidance yet for 2023. So where are you now for 2023? And do you have confidence in that number? Or do you think there's downside risk to that number?
So we actually did adjust our number down, Tim, a decent amount. So this year, our number is in S&P profit terms, which doesn't mean anything except for geeky guys like me, but we have $227 of S&P profits in 2022 and only $230 next year. And the reason is that the decline in the revenues, well, the revenues are going to continue to move up, but the margins are going to basically bite it for the reason that I was just mentioned before. As a matter of fact, if you look at the difference between, the 227 and 230, it's basically flat. The only thing you're really getting on that EPS is just buybacks.
Yeah.
So,
and Jonathan, go ahead.
No, please.
And where on the revision front, if you look at things on an ex-energy basis, how rapid do you feel like your revisions are coming down? How big of a difference does it take when you strip out energy?
It's a pretty big deal. I mean, I can read you some numbers if you want it on it, but I think that there's a part of that we have to kind of not simply throw out the thing which looks really brilliant without throwing out some things that look horrible on the other end. Yes. I mean, let's talk about, so energy is looking really strong, but materials aren't. Materials are weaker. And normally they track together, but right now they're not. And in the last quarter or two, the revisions have been great in energy, but oil prices are well off their peak levels. Gas at the pump is well off peak levels. So why is energy revisions? Why are the expectations for what an energy company is going to make? Why are they doing better? It's actually because there's a lack of refining capacity. So it's not a Ukraine issue. It's not it's not an economy recession issue. It's the fact that we've underinvested in refining, and that's some of that's companies, some of that's public policy. And if you said to me, kind of what are there's really three groups that are funky right now in terms of earnings. So the first one is energy, where the oil price is not driving it as much as this other thing. Tech, which since the iPhone came out in 2008, and for more or less every single quarter for the last 14 years, tech companies have kind of done a better job of delivering their earnings than the rest of the market. Not every quarter, but directionally. This is the worst that tech has done relative to the rest of the market since the iPhone came out. The earnings growth is really problematic, but the revisions are actually, we keep having this hope that tech is going to turn around, and then they keep disappointing. So they're missing by more than others are. They're being revised lower. And then the other one, which is weird, is financials, which because you have banks take these reserves for future losses. You run a bank, it's doing perfectly fine. Nobody's defaulting on a loan. What do? You take a hit to earnings because you think maybe next year there'll be a hit to earnings. Now, it's not, you have no particular insight, and it's not showing up in your business. That's the way the regulation requires you to, the accounting standards require you to do things. So that sector would probably be a lot better.
Yeah, I mean, I think there are two things that keep me probably less sanguine on earnings growth. I totally get the point on nominal terms, and companies do seem to still have this pricing power. Consumer demand stays so strong, but housing really is breaking down pretty hard. And we're in a freeze in housing, and I think the next step is that you have to have lower pricing. You can't more than double the cost of capital in the housing market and not see downward pricing. And I think there's going to be a meaningful wealth effect that I do think will crimp demand, because I am a believer that sort of as housing goes the U.S. economy. There are just so many knock-on effects to that. On one prior point that you made, which is so much in our wheelhouse, is this underinvestment concept in energy. I talk about it a lot, where CapEx in the refining sector is down 50% in 3 years. And if you talk to your energy analyst or any energy analyst, they'll tell you, we're never building any more refining capacity in this country. And it's an amazing thing that this mantra of give me the money back, do not reinvest capital into what may be, while it's a very, very, very slowly melting ice cube, still a melting ice cube. I got to think that energy profits, because of the lack of reinvestment upstream and downstream, will stay really strong. But my bigger concern on the near term.
Tim, if you would have asked me a year ago or 18 months ago to make what's my favorite sector, not for the quarter, but with a 10-year view, it had to be technology. Yeah. That is entirely shifted for the exact reason you're mentioning. I don't know whether it's 10 years, but next 3 or 5 years, energy should really be a very, very profitable sector, and the cash flows should be really strong because of this lack of investment, and there's all kinds of implications. But I agree with you. I think it's going to be a really interesting place to put your money.
And then on that other point that I made, do you have concern that you're going to see a wealth effect from housing? I know we're in a better position than the rest of the world because so many of us have 30-year mortgages. The best thing I own is my mortgage, for God's sakes, at 2 7/8. I'm very proud of that. But still, there is going to be a wealth effect, I've got to think.
Yeah, so there's a bunch of different issues there. So first thing is, what are the things that drive consumer spending? Because we know that the consumer is the most important driver of the economy. So the first thing is, do you have a job that you're confident that you're gonna keep? And right now, while we in the industry are talking about how the economy may go into recession and the like, there is an enormous number of open job recs. So if I did lose my job tomorrow, and I'm not concerned that I will, but if I did, I can go across the street and find a job making similar money. And that's true of an investment strategist. That's true if you're waiting tables. And if you think about making a long-term commitment, I'm buying a house, a car, whatever it is, remodeling my kitchen. Yes, I care about the financing rate for those things, but the number one question I have is, am I confident I'm going to have a job tomorrow for me to be able to make those investments? And that's the answer right now is that's a home run. But you're absolutely right. If we do see a correction in housing, even if, let's say I told you that your house is now worth 10% less, you're not moving, nothing's changed, but in your mind, you know that's worth less. You are, statistically, you're less likely to buy a new refrigerator or redo your roofing or paint your house. And those are all parts of the economy. Even if you never realize the sale of that house, it's going to change what you do. And it doesn't affect every company or every sector of the economy equally, but it is a really big, real big impact.
Yeah.
I'd be curious to hear both of your thoughts on, moderate inflation. Obviously, like when U.S. has had good real earnings, when inflation's between 2 and 4, we haven't obviously this year in terms of a stock sell-off. So I guess what's the inflection point between good inflation and bad inflation?
You want to take that, Tim, or you want me to take that?
I mean, look, I think we're in bad inflation mode. I don't think there's any two ways about it. I am afraid that the Fed has gotten itself way behind the curve, and we are in a bit of a wage spiral. I think there's a ton of drivers to that. I think we have a worker shortage. I don't think that worker shortage is going away. And I think that the worker shortage, which is driven by, aging demographics, deglobalization, falling productivity, male labor force participation rate that's been going down only for 70 years. I think all of those are drivers to keeping this worker shortage and this wage price spiral in place. And I think the Fed is going to have a hard time in breaking that for the reasons that Jonathan just enumerated, which is that there is so much demand for labor. You look at the NFIB this morning, what was the number one complaint? They still can't find workers. And so you have compensation going up and you have profitability optimism going down. So, I think we're in the bad spot for inflation, but Jonathan makes a very good point at the outset here, which is that companies report in nominal terms. Companies raise prices beyond where their pricing pressures are coming. So the top line may stay stronger than the bears would think, but I do think there is increasing pressure on operating margins, on gross margins.
So Drew, let me take let me just take the question on directly, and Tim raises a whole bunch of additional points that are worthwhile. But there are two things that drive the value of a company. It's really simple. What are their cash flows and their earnings, and what's the discount rate you put against them? This year, we started with 150 basis points on the 10-year. We're ending with over 4%. In a really simplistic way, I could care less what inflation is. If my discount rate goes up almost 3 times, the value of an asset. And people think about bonds, we know really simply, interest rates go up, bond prices go down, but it's exactly the same for equities. The only difference is a bond, exactly what the cash flows are going to be, and in equity, we have to kind of guess at the cash flows, and they change over time and things like that. But it's the same math. So our work shows that when interest rates rise, that from low levels, they go from 1.5 to 2, what generally happens is the stocks go up. And that's kind of like confusing because I just told you that your discount rate rises, but why do interest rates rise? Because there's an increase in demand for capital. And when you have an increase in demand for capital, that means the economy is strong. So when you have interest rates rising from a low level to a medium level, your discount rate goes up, but your projections for the future go up, your equity risk premiums fall, and all's great. There's an inflection though, where when interest rates go up beyond what's reasonable or normal to something that is now choking the economy, making it, to Tim's point before, making it harder for people to go out and lease a car, or harder to go out and buy a home or what have you. And then you have a rising discount rate. Now it's not funny anymore. And our work shows that it's about 3.5% on the 10-year is that inflection point. So you asked a question in terms of inflation, and I'm answering in terms of interest rates, but that's what our work shows. And I also think that Tim makes a really good point that, if you're a company, let's think about it as an individual. What I want is high wages, and I want corporate pricing power to be weak. I want to go to the store and buy eggs at the same price as yesterday, but I made more money. That's what I want. If you're a corporation, you want the opposite. You want low wages and high pricing power. Here's the problem, and you see this. I know you're going to get political later on with some of your questions, but if you look at what the administration is saying, or what Republicans or Democrats are saying, that they're talking about, job creation and all, but the economy is actually running way too hot, and this wage inflation, it's great for you as an individual because you have more money in your pocket, as long as the guy that is employing you, if he's losing money, he may ultimately be forced to fire you because he can't pay the higher wages. So it's a double-edged sword, and what we really should hope for is something that's stable. What we've had in the last, 12, 15 months, it's not that long. This inflation problem hasn't been with us for years. It's relatively new, but we've gone from a situation where people were having a problem paying their bills because CPI was going up faster than wages. What we're going to see in the next 12 months, Drew, is that CPI is going to fall, but wages are going to stay higher. So now you're going to see a situation where the consumer is going to feel emboldened. They're going to feel great. And the employer is going to start having a bigger problem. And neither one of those are healthy.
I guess that kind of brings us to, long-term outlook. What do we see in terms of equity returns, bond returns over the next couple of years?
You want to go first, Jonathan?
Yeah. So, Tim was commenting before about the demographics and things like this. I mean, we have an aging population in the U.S. We have an aging population around the world. The single country that has the population aging the fastest is China, because of their one-child policy. And so this extraordinary, miracle of Chinese growth that we've had over the last 30 years, which has fueled a lot of global GDP, that's probably well behind us. And if you look at the success that we had in the 70s, 80s, 90s, a lot of that was because women entered the workforce for the first time. And that's behind us. So we're probably looking at a much weaker global GDP than we've had for really in the post-war period since the end of World War II. And the other thing is we've had for the really since the fall of the Soviet Union, or maybe even well before that, we've had this burst of globalization that's really been beneficial to not only to us as Americans, but to people all over the world where we've lifted living standards and the like. And we're seeing with, some of the political challenges, whether it's Russia and Ukraine, or whether it's China with Taiwan, or other things of this nature, that we're likely moving to a world that's a little bit more insular. And part of the reason for that, Drew, also is supply chains. It was really great in the kind of before COVID, where you built a car and you got the best, cheapest part from wherever in the world you needed to get it. The problem is that when you have 50,000 suppliers on one vehicle, you have 50,000 people who can screw up your ability to make a car. So now we're starting to move things incrementally back onshore, or if not onshore to the U.S., within the region, right? So maybe things we made in Mexico, maybe the U.S., but we're not going to have as much over, let's say, in Asia as we had before. And all of these things are actually growth negative. So if we're in a world where right now we're experiencing a lot of inflation because we have a very tight labor market, it's on the other side of this recession that we're going to experience. I don't know whether recession is in 1 or 2 quarters from now, or 5 or 6 quarters, but there's always a recession in your future. On the other end of that, we will end up with more capacity in the labor market. We will end up getting rid of this problem of lack of availability of labor, and inflation will come down and things will renormalize. And that means that interest rates are likely also to come down, because the longer term trend is weaker growth. So let me maybe summarize this. We are in a secular weak economic inflation and growth environment over a period of 30 years or 20 years, whatever it is. And we are having a totally messed up current environment, not only because of the pandemic, but because of the insane amount of stimulus we put against it, which distorted everything. But we will work through that, and we're going to end. So this is not a permanent environment that we're in right now. I don't know whether it lasts a year or two or three more, but we will quickly work through this and get back to something that feels much more like it did, in the 20 teens.
Yeah, it was turning into a love fest. You had me there until the end, where I tend to agree more with your colleague Zoltan, who kind of makes this argument with, I think he said in that piece that he wrote a couple months ago, I don't know where the workers are, but it's like waiting for Godot. They're not coming back. So I guess I'm less sanguine, and I feel like the worker shortage is going to be structural. It is not ephemeral. And while we'll have, the Fed will win, the Fed will get unemployment higher here in this cycle, in this impending recession. But I think that the wage pressure and the worker shortage is here to stay, because as you say, the demographic challenges are not just in the US, they're obviously in Europe, they're famously in Japan. People are now recognizing that the Chinese have been lying about their demographic issues to some degree. No surprise. Korea has one of the lowest birth rates. Taiwan has the lowest birth rate in the world. So all of these countries are shrinking. We are bringing manufacturing back. It's wild to see in non-farm payrolls and actually see growth in manufacturing. So I do think there is going to be this wage pressure that stays with us on the other side of the impending recession. And that's where I worry about multiples. The concern that equity multiples, look, all GDP is, as you pointed out, is workforce growth and productivity growth. We could talk about productivity, but I think we agree that workforce growth is going to be a problem. And it makes me worry that the multiples that you want to put on the equity risk premium probably needs to go higher, because we are not going to see the kind of profit growth and top line growth that we've been able to achieve historically.
All right, so Drew, we're going to take the gloves off of here, but I'm going to tell you why I don't agree with Tim on this. At the end of the day, all inflation comes down to wages. Your gardener may want a raise, may want more money for your gardening or whatever, but at the end of the day, it's because he has to pay somebody's wages. And even the goods, even the fruits and vegetables that we buy, at the end of the day, it's because somebody has to pick them or process them or drive them someplace. And if we end up with a tight labor force, Tim, like you mentioned, the Fed is going to have to clobber the economy, and in a large enough way that they bring. Right now, what you have is demand for labor is greater than the supply for labor. So what you're going to have to do is you're going to have to kill that demand. And if that labor shortage persists, it just means that the Fed has more to do. And what I fear is that, just think about this: the Fed would normally want to see to bring inflation control that the Fed funds rate is running above inflation. Well, headline inflation is 8%. Core inflation is running closer to something like 6%. So, the terminal rate on how far the Fed has to go may be much higher than we all want to believe. And I think so it's not as if I think that we're done with this thing. I just think that the Fed is going to ultimately force a reckoning on this thing and bring it under control. And the only question is, how ugly is that reconciliation process, and when exactly does it happen? My gut tells me this is a medium recession, and it starts in early 24, maybe late 23, not sooner. It's not a 2008 kind of recession, but the longer this goes, and the worse, the stickier this inflation proves to be, the more the Fed's going to have to beat this thing up, and that's a fear. But on the other side of it, I do think multiples end up being higher.
So Jonathan, no recession until early 24, and is that just because we still have so much pent up excess savings from the excess stimulus from from the pandemic?
Well, not that would. First of all, I think that that's true, but there's two big reasons. First, if you look on average, when the yield curve inverts, and when I'm talking about the yield curve, I'm talking about the 3-month 10-year. On average, it takes 11 months to start the next recession,
Okay.
and it just inverted like a week ago. So
Yeah.
all else being equal, that tells you that we should have a recession, next October. However, the range runs between 5 months and 17 months. So roughly speaking, let's say the recession starts somewhere between April 1st of 23 and April 1st of 24. So then the question is, where in that range are you? And that mostly depends on the conditions in the labor market, but it really is how many available jobs are there. So let me give you an example. So let's say, Drew, something bad happens to you and now you're looking for work. If you have to find that job and there's a ton of open job positions, you're going to keep spending. You don't care. Everything is fine. If on the other hand, we start burning through those open positions right now. So what's like normally there's about 5 million open jobs late in the business cycle. Now there's over 10 million. So, you lose your job, you find one. Getting fired doesn't matter as long as you can get something else and you keep spending and everything's good. The overhang of excess jobs because of what you're talking about is just so much bigger than anything we've seen.
Yeah.
That people are able to keep spending. And how long will it's really not clear how long it'll take to burn through that. But if 11 months from now, roughly, is when on average a recession would start, plus or minus a bit, I think you're on the plus a bit. I think it's a little further out.
Yes, how should we evaluate the Fed so far? Obviously, this last Tuesday, they hiked it a bit more. We might see a couple rate hikes in 2023. It's obviously tough to tame the beast, getting a lot of flack, but be curious to hear your opinions. Let's start with you, Jonathan.
So if you would have asked me this question 6 months ago, I think it was really clear that they were way behind the curve on this thing. They were really wrong about this transitory thing. Listen, it's really hard to predict the economy, but they got it wrong. And the terminal rate that they were saying how far they would take interest rates to, people are like, well, they'll take it to 2%. And it's like, there's no way they're going to have to go to a much higher number. This move of 75 basis points 4 times has been really bold on their part to get to an interest rate that's in the zip code of reasonable. And I think they're doing something. Powell's comments I thought were really spot on, which is right now the economy needs some time to process these rate hikes. It's about a year of delay, so they can keep pummeling the economy with 75 more and 75 more, and then all of a sudden we're going to find that they overshoot. So they brought it to a level that the right thing to do is to start to move in 50s and probably 25s, and just to slow down the pace so they can give the economy a chance to give them some feedback, so that when we have that next recession, it's an average or mild recession instead of blowing this thing up. So this is really, really hard stuff. If I were Jay Powell, I'm not sure I would have signed up for a second term in office, because I think this is going to be really rough going. I also think that we have this assumption that this process is going to be smooth. When the economy, when there's low inflation, everything that goes wrong in the economy, the Fed just eases. They just print money. That's easy. That's a great job to have. We all wanted Bernanke's job. Now you have a situation where you're trying to beat up on inflation, and the second you really do a good job of it, you're going to start killing the patient, the economy, and then and I think that there's a decent chance that there's a little bit more back and forth than we think. If you look back at what happened in the 80s and the 90s, it wasn't smooth. We moved a bunch, we pulled back a little bit, we moved again, we pulled back again. It's a much more fluid process than we think in periods where inflation is high and growth is weak.
Yeah.
But Jay Powell is I think managing a really rough situation pretty decently right
Yeah.
at the moment.
Yeah, and I think I would agree with absolutely everything Jonathan just said. They got off to a really bad start. Let's not forget they were buying mortgage-backed securities when it was pretty clear that we were in a bit of a real estate bubble. You had affordability, even when rates were still really low, getting problematic. All the ratios showed you that housing was way overvalued. So why were they still buying back mortgage-backed securities? They made a terrible mistake when they said, we're not going to anticipate inflation anymore, because that's been the wrong move. We're just really going to wait until it's punching us in the face. And unfortunately, they got what they're asked for. But that's kind of all water under the bridge. Jim Bianco likes to say that with the recession, we aged by 10 years, and it brought forth all of these things that we have been talking about, like the demographic issues and the worker shortage and so forth. So I think where they are now is where they ought to be. They had these 475 basis point moves. They're going to go 50. They're going to go 25, and they're data dependent. I mean, the Fed statement should be real simple every single time. We're data dependent. We don't know. We're going to see where the data takes us, and yet we hang on every word. But I agree with Jonathan. It's going to be challenging because this persistence around wages and around energy inflation, even in a slow and potentially slow GDP economy, I think it's going to be tough on them, and I don't think they're going to have much choice to kill the patient. I don't really agree with the Larry Summers of the world, who says they got to go to 6% and maybe even higher than 6%. I think that, especially because housing goes first. Housing is what is the first thing that they can really affect. I think it's going to have a meaningful impact on the economy. So getting out there where they're only doing 25 basis points or nothing, being data dependent, and watching to see what consumer demand looks like is the right thing to do.
Today's election day, so I'm not going to spend much time forecasting. Hopefully we'll find out sooner rather than later. There's not a lot of hanging chads in Georgia or Pennsylvania. Sometimes a couple days, but I guess our position, Jonathan, is that the Democrats are going to lose at least one chamber, most likely the Congress, and then maybe the Senate as well. How much of this is built in? I mean, how much do midterms really affect capital markets over the next couple of months? I just see policy paralysis, once this is all said and done for the next couple of years.
I'll tell you, it's interesting on the evening that Trump beat Hillary. I was out watching election results, actually at a bar with all the, what used to be a sports bar all of a sudden became an election results bar, and I got a phone call from Bloomberg TV asking me to go on and very last minute to go and co-host the show, which I wasn't ready for or anticipating, but it was close. And you actually at that moment they were watching the Mexican peso was melting down, and and the S&Ps, the futures are going crazy, and I did that. I was asked to do this one, and I actually declined. But I think this probably matters less. I mean, the Democrats had 2 years where they had both houses and the presidency, and largely because of whether it was Manchin or other things where they really weren't able to get everything they wanted done. It was probably a little bit less effective. The president was successful from his perspective at using executive privilege to get a number of things through, things like student loans, but really did it around Congress. And I think those are going to end up being contentious issues that'll probably be challenged in the courts and the like. But if he couldn't get all that much done through Congress in the 2 years because of some of those challenges, this was the shot, and it's probably gone. Now, from a markets perspective, that probably is it's probably not a terrible thing. The government that's a little bit more hands off is probably not bad. Right now, the government has been overzealous already on providing stimulus. I think it's going to be impossible to do more stimulus in this kind of environment. So it's probably the market's anticipating split Washington. They're going to get a split Washington. Whether I think that the big thing that's going to come out of this discussion is not going to be, well, the House, everybody's assuming, like you said, is going to go to Republicans. The Senate looks like it's going to be a toss-up, and it'll be close. I think the real question is the Republicans who win office. Most of those we're gonna find are people that were endorsed by Donald Trump. I think that this is going to be incredibly empowering to Donald Trump, and I think we're going to see his voice, which has been relatively quiet in the media and the like in the last couple of years, is going to become much more visible. And I think he's going to be playing a larger role on the political landscape than he was before. But I'll just make one quick comment, and I'll turn it over to Tim. I say this, and I kind of piss off both Democrats and Republicans. The American president, for the most part, acts like the American president. We don't want to think that. But Trump's policy on China, or Trump's policy on Mexico, or Trump's policy on stimulus after the pandemic was surprisingly similar to Biden's policy on all of those things.
Yeah.
And we would like to, and it's really easy to say Biden created these jobs or Trump created the strongest economy, blah, blah. But in reality, a lot of this is the backdrop they were operating in. And in most cases, regardless of who your candidate is or your party is, the president really does act like the president more than we think and more than we want to believe. So I think this is probably going to prove to be less of a big deal. There are individual specific narrow areas that it'll matter, but you're going to be split anyway.
Yeah, I agree with all that. The market's already anticipated having McCarthy in charge of the House. Whether or not the Senate goes Republican as well doesn't really matter that much, for as far as I can tell, outside of judges, and judges right now don't really have an impact on the market. I think Jonathan's dead right about that for the things that matter to the market. Immigration, we need more legal immigrants. That trend came down under Trump. It hasn't gone up under Biden, because Biden knows that Ryan and Fetterman in Ohio and Pennsylvania can't run on a nuanced argument that actually, guys, if we bring in more immigrants, it'll help us grow industries and that'll be good for employment. That doesn't work. So, I think we'll have government that gets very little done. I think the risk is that we have a big debt ceiling fight. The question is, do the Democrats in this lame duck Congress coming up, do they take the debt ceiling much higher? Because otherwise you're going to have a real duel between Congress and the president, and the likely impact will be slower CPI or slower COLA adjustments for Medicare and Social Security. But again, I don't think that's terribly meaningful to markets here. The historical precedent of when you have a Democrat in the White House and a Republican Congress, that's been good for markets. I don't really care about those kind of historical stats. I think they're more quirks, nor would I have thought that I would have gotten more bearish if the Phillies won the World Series.
Yeah. So
it would have pissed me off, but it wouldn't have made me more bearish as a Mets fan.
Yeah, it wasn't the Astros saving the American economy.
No. Mattress Mac did not actually help.
All right. Well, sounds good. Thanks for your time, both of you gentlemen. For all listeners and subscribers, be on the lookout for this in both video and in the podcast settings. And we're out.